Hello everyone and welcome back. I do hope you're all keeping safe and well. Thank you very much for joining us for this, the latest BKL webinar, an introduction to UK tax and trust issues. Suffice to say, this being tax, it is an extremely complicated area, so we're going to focus on introducing the key concepts and identifying those areas where mistakes are easily made. I'm Anthony Newgrosh and I'm delighted and somewhat relieved to be joined by three resident experts. We've got Lindsay House and Kate Saunders from our Trust Tax team. Hi Lindsay, hi Kate.
Hi there.
Hi.
And we've also got Geraint, who heads up our private client offering. And we all work together to provide our tax consultancy services here at BKL. We're just one big happy family, aren't we, team?
Yes.
I'll take that as a yes. We're going to try not to get too technical today, but if you do have any questions along the way, do feel free to raise them. You can type your questions. We'll do our best to answer them during the session, but rest assured, if we can't cover off everything, then we will try and come back to you after the session, when we'll also be sending you copies of the slides and the link to this webinar, should you wish to listen to it for a second time. When will the excitement end? Any technical problems, we have our resident expert and good guy, David Goldstein, as our producer. Thank you, David, for all of your work, and he'll do his best to help you out. So, with all the wonderful predictability of yet another Manchester City Premier League title, let's get cracking. And just to flag up as we start some of our BKL services for trusts, we suffice to say, we do it all, don't we, team? We provide accounting services, general trust administration, everything else you can see on that slide, from the compliance, the preparation of self-assessment tax returns, to more complicated IHT matters and offshore trust structures. So, as I say, today we're going to introduce very gently to you some of those matters. But to lead us off, I think, Geraint, you're going to pick up the cudgels. Let's talk about where we start with trusts, onshore, offshore. Take it away, Geraint.
Thank you very much, and hello, everyone. Right, identifying the tax status of a trust. Well, the first thing that we always look for when we have a new trust is to try to identify what the tax residence of that trust is. Now, the tax residence of a trust is unsurprisingly dependent upon where the trustees are resident. Now, there are kind of broadly two types of trustees. You can have individual trustees and corporate trustees. Now, an individual trustee's resident status will be defined by the statutory residence tests. So those of you who deal with personal tax matters and will have had the pleasure of wading through HMRC's easy to read 105-page basic guide on statutory residence will know that this can be a very complex subject. Corporate tax residence is, of course, dependent upon the tax residence of the company, which would be to do with, are they conducting business in the UK through a permanent establishment? Now, if I can briefly touch again on the individual tax residence, because we keep on seeing this problem arising whereby people from, say, Australia, where you have a lot of people with quite small trusts of which they themselves are trustee, if they then move to the UK, not only are they importing themselves into the UK, but they are potentially importing the trust into the UK as well. Now, it's interesting to note that if someone becomes UK tax resident but is able to claim split year relief, then that split year relief will be respected for tax residence purposes or trust residence purposes, as long as the trustee resigns or is removed during the overseas part of the split year. So the person coming from, say, Australia to the UK needs to get themselves out of being a trustee prior to their split year commencing in the UK and to be replaced with another non-resident trustee. Okay. Now, it's quite clear that if the trustees are all UK resident, then so will the trust be. And also, if all the trustees are not UK tax resident, then the trust will also be not trust tax resident. However, what happens if you've got mixed trustees, i.e. some are UK resident and some are not? Well, in these circumstances, we have to look at the status of the settlor. So was the settlor either UK domiciled or UK resident at the time that the settlement was made? If the answer to either of those two questions is yes, then the trust will also become UK tax resident.
Okay, why does all of this matter, Geraint? What's the key difference between having an offshore and an onshore trust?
Well, that's a very good question. And as usual, it's all down to tax. So the tax treatment of a UK trust and the tax treatment of a non-UK trust are very different. A UK trust, broadly speaking, is taxable on all income and gains arising in it, whereas an offshore trust is only taxable on UK source income and capital gains to the extent they relate to UK real estate. So the problem HMRC have is that policing offshore trustees is extremely difficult. So the offshore tax regime tends to focus on taxing the settlor and the beneficiary to the extent of their UK tax residence. However, for the purposes of this talk, we'll park the offshore trust matters because they are very complex and will maybe be the subject of a future a webinar, and we'll focus solely on UK trust matters.
Okay, thanks, Geraint. And picking up on that, I think the next key concept we need to explain is one of relevant property trusts.
Absolutely. So I think the issue here is, having deciphered what the tax residence of the trust is, we've really got to start to look at what kind of a trust it is. What is going to be the tax treatment of this UK trust? So obviously your first port of call in all of this is going to be to review the trust deed, take a good long hard look at it and try to understand what it's trying to get at. What kind of a trust is this? Is it a discretionary trust? Is it an interest in possession trust? Is it an 1825 trust, a bereaved minors trust? There's all kinds of trusts that it could be, and they all have subtly different tax treatments. Now, most new trusts being set up are what are called relevant property trusts. So that obviously begs the question as well, what is a relevant property? Now, this phrase relevant property comes straight from the Inheritance Taxes Act, I'm afraid. Chapter 3, Part 3 off the top of my head, so please don't correct me if I've got that wrong. And it basically says that relevant property is subject to a specific inheritance tax regime. And if a trust is a relevant property trust, then it will be liable to entry charges, exit charges, and periodic charges, depending on what's going on in the trust and the value of the assets within the trust. I know that my colleagues Kate and Lindsay will be talking about this in a little bit more detail going forward. Now, there are some trusts that are not relevant property trusts. And these are trusts such as excluded property trusts. Now, these are trusts that are generally set up by a non-domiciled person prior to becoming UK domiciled and predominantly carry non-UK situs assets. These are very efficient for UK inheritance tax purposes. There's property that's subject to a qualifying interest in possession, and I'll talk a little bit about that in the next slide. There are certain categories of property held on trust for children. And of course, there's employee benefits trusts, which are a whole subject in their own, and we won't dwell on too much during this particular webinar. Now, the most common form of trusts that we encounter are discretionary trusts. And these are, as the name suggests, these are trusts in which there is a discretionary class of beneficiaries, and the trustees have complete discretion as to who is to receive income and capital and in what circumstances.
Okay, and they are relevant property trusts in their own right,
And
aren't they,
they are
guys?
indeed. They are indeed. Yes. Yeah.
Okay. All right. You were going to explain a little bit more to us all about qualifying interest in possession trusts, Geraint.
Yeah, absolutely, absolutely. Now, there are broadly two kinds of qualifying interest in possession trusts. There's the trusts that the individual became entitled prior to the 26th of March 2006, commonly referred to as pre-2006 trusts. And there are those where the individual became entitled after the 22nd of March 2006. And for the post March 2006 interest in possession, the possession also has to be what is called an immediate post-death interest. I mean, these are sometimes called IPDs, and these tend to be settlements created by a will, and in which the beneficiary becomes entitled on the death of a testator. There's a disabled person's interest, which is self-explanatory, and there's what's called a transitional serial interest, or a TSI. And this is where the transfer of a life interest is taken by a spouse on death. Now, none of these form relevant property. So anything in these are not liable to the inheritance tax charges that run through a relevant property trust. So it's very important that if you do have a qualifying life interest, you recognize it and act accordingly.
Okay, so we've talked about onshore and offshore trusts, and we've talked about identifying whether we have a relevant property trust and the exclusions. And we'll talk about, in particular, the inheritance tax consequences of being a relevant property trust in a second. But let's just pause for breath, because one of the things we need to discuss, and one of the things we need to be very mindful of, is the importance of record keeping when we're talking about trusts. And I think Kate and Lindsay, you're going to expand upon that now for us, please.
Indeed, thanks, Tony. Yeah, we can't express how important it is to maintain good records. HMRC regards it as the trustee's responsibility to maintain the proper records of the trust. There's actually no statutory requirement for trust accounts to be prepared. So unless it's specifically stated in the trust deed, the trustees are not obliged to prepare them, except if there's an audit requirement to do so, of course. But it is important to keep good records, especially things like the trust deeds, and that's not just the original trust deed, but any deeds of appointment of capital or changes of the trustees or protectors, changes to beneficiaries or their entitlement to the assets, as these can all have sort of tax consequences. It's also useful to have things like a family tree, which is kept up to date and includes things like the age and domicile of the beneficiaries, and these are particularly useful when you're doing tax planning. An inventory of the trust assets is also vital, and to keep track of any transactions that take place, the acquisition costs, any disposal proceeds, costs of sales, and other relevant costs such as enhancement costs when you're dealing with real estate.
Yes, and I would say that I've probably spent about a third of my working life sort of dealing with trusts with incomplete or poor records. And one of the earliest cases I worked on involved a landed estate, and on the death of the lord of the manor, the estate and chattels passed into a life interest trust for the surviving spouse, and that's sort of like bog standard tax planning. And then on her death, we completed the IHT return for the trust. There were no accounts to speak of, and the return was simply based on the valuation of the chattels prepared by Sotheby's and the valuation for the house. And inheritance tax was paid on that basis. So all well and good. And then about 6 months later, though, we got a letter from HMRC asking what had happened to the Gainsboroughs and the snuff box collection, both of which had a significant value on the death of the Lord. And the trustees had no idea what had happened to the chattels, and the only child had not taken them, and she swore she had not seen them since her father's death. And to cut a very long story short, a settlement was eventually reached with HMRC on the basis that the missing assets had been gifted to the spouse, and then she had gifted them on to an unknown third party. And the trustees couldn't prove when that had happened, and so IHT was eventually paid on the basis that it was a failed pet. And the daughter also made a claim on the trustees, as of course they were responsible for the safekeeping of the trust assets. And it was a very valuable lesson to learn, I think, very early on in my career, and I've sort of applied those basic principles to everything I've worked on since then. And I'm a very big fan of having detailed accounts, that are prepared using the STEP guidelines for these larger trusts, as this provides the trustees with all the information they need for effective tax planning. It's a Bible. You've got the key dates are all mentioned in the accounts, etc. And also, I should add, any new trustee coming on board, they'll want to see good records, good trust records, because of course they're asked to indemnify the outgoing trustee.
Yeah, that's right. And it's also vitally important to keep a good record of any undistributed income where it's relevant. I know Lindsay's going to be explaining the significance of this later on, so I won't go into any detail right now.
All right, well, thank you. Enough said. As complex an issue as trust taxation is, as I think you've set out very clearly for us there, it's often just the practical points that things go wrong, isn't it? Just we don't have the records to compute the tax correctly. And just one quick question. You mentioned about there's no statutory requirement to prepare trust accounts. I think you've made it clear you would recommend it. Does that typically happen in your experience?
That can vary. I think we have a range, but it's often difficult to prepare accounts going back. So particularly when you come to 10-year anniversary charges, which we're going to talk about later on, but preparing accounts from records going back 10 years is often more difficult. So doing them on an annual basis is highly recommended.
Yeah, I would suggest even for the smallest ones that you have a balance sheet prepared each year, simple balance sheet. You don't need necessarily to have full accounts, but you do need to understand what's in the trust.
Great stuff. Okay, thank you for that. Right, Geraint flagged up before, and we'll look at this in a bit more detail now, the inheritance tax consequences of being a relevant property trust. Do you just want to talk us through when we might have IHT charges arising, and then we can expand upon that and some of the issues in a bit more detail?
Yes, certainly. In practice, relevant property trusts is where we see most commonly the errors occurring. Generally, there are two rates of inheritance tax that need to be considered. It's either a maximum of 20% or a maximum of 6%. These types of trusts are subject to inheritance tax, as mentioned by Geraint earlier. That's either on entry, so when the assets are actually settled onto the trust, which would be a maximum of 20%. There could be a 10-year anniversary charge, which is sometimes referred to as a periodic charge, which could be a maximum of 6%. Then on exit, so when capital is distributed from the trust or the trust is wound up, there could also be a maximum of 6%. But also, if the settlor died within 7 years of setting the trust up, there could be a maximum of a further 20% payable. However, if gifts with reservation of benefits rules apply, the death of the settlor at any time could also trigger an inheritance tax charge.
Okay, Kate, are you able just to summarise what we mean by gifts with reservation? When does that typically happen?
Well, that's often if the settlor retains a benefit from any of the assets which have been put into a trust. So, for example, if a property was settled into the trust and the settlor remained living in that property, he would be, sort of gaining a benefit from that. Understood.
Thank you. Thank you for clarifying. Okay, that seems to me like an awful lot of tax. Lindsay, what can we do to mitigate and plan for all of those different IHT charges?
Well, typically the lifetime trusts created these days are within the nil rate band. That's 325,000 when settled. So there's no charge to tax when the trust is created, and any capital appointments made within the first 10 years are free of tax. The exception to this rule is where agricultural and business property relief have been claimed on settlement into trust, as the exit charge is calculated by reference to the gross value of the property settled, and that's before reliefs, and this may result in an effective rate of tax. So prior to the 10-year charge, you really need to have a rough idea of the IHT exposure so that you can make appropriate plans to mitigate the tax. And if it's a nil rate band trust, there could be merit in winding up the trust before that first 10-year anniversary. For example, if the value of the trust had risen to say 500,000, that would result in an IHT charge of 10,500 on the 10-year anniversary, whereas there would be no IHT charge if the trust was wound up before the first 10-year anniversary.
Okay, that 10,500, Lindsay, how was that calculated?
Well, that's just say that's 500,000 minus 325,000, the nil rate band at 6%.
Okay, thank you.
6%.
Mm-hmm.
So in addition to any unrealised investment gains, you could potentially be held over for capital gains tax purposes. So potentially you can get the assets out free of inheritance tax and free of capital gains tax. So on the face of it, that would seem like a really good idea, but you really do need to weigh it up the pros and cons of putting capital directly into the hands of the beneficiaries. Whilst it's in the trust, it's protected, and when it's in the beneficiaries of hands, of course, it's theirs. Mm-hmm. And for example, if you've got very young beneficiaries or they're vulnerable beneficiaries, then you should really need to weigh up the pros and cons. And I do remember a case where the beneficiary, she kept pressing the trustee to wind up her trust early because she wanted to invest in a boutique coffee shop. And eventually he did. He gave her the money, and unfortunately the business went bust and she lost everything. And it's potentially if he'd had kept the money in the trust and maybe lent her the money or something, it would not have all gone. So when we sort of identified what the IHT exposure is, and if you're looking at a large tax bill, then you should consider, or you could consider, switching chargeable property with relievable property. For example, AIM shares or shares in unquoted trading company, which qualify for 100% business property relief, or maybe agricultural land and farming business, etc. But you need to hold these assets for 2 years in the case of AIM holdings and business shares, and 7 years for agricultural property in some cases. So really you need to be looking at all this well in advance, because it can take a long time to put everything into place. Because so to meet the 2 and 7 year requirement, I would say you need to look at everything at least 6 months prior to the 2 and 7 years. Obviously you need to weigh up the capital gains tax cost of switching assets to see if it's a viable option. So you really need to sort of consider everything well in advance, is what I'm saying there. And then we look at the income accumulations. Now, income is either distributed, and that's paid out to beneficiaries, or that's accumulated. When it's accumulated, that's when the trustees have sanctioned the transfer of income to capital for perhaps reinvestment, or it's undistributed, and that's where the trustees are holding the income in reserve pending a decision to pay it out to the beneficiaries. And it's really important to keep a record of this income, as from April 2014, undistributed income which arose over 5 years prior to the 10-year anniversary, that's now deemed to be relevant property for the full 10-year period, and it's therefore subject to the tax at the rate of 6% on the 10-year anniversary. And we've seen some very large accumulated income balances, so you could be looking at a really hefty tax charge here. If there is a tax planning opportunity out there, if the trustees formally accumulate any income which falls into this 5-year plus category in the quarter immediately prior to the 10-year anniversary, you can bring the tax rate down from 6% to 0.15%, and that's because the accumulated income will only have been relevant property for 1 quarter out of a potential 40 quarters. But it should be noted, though, that once the trustees have formally accumulated the income, it becomes capital, and any subsequent distributions will generally be treated as capital in the beneficiary's hands, and i.e. you'd be distributing capital to the beneficiaries instead of income, so they wouldn't be able to reclaim the tax, the normal tax on the income distribution. And that's covered in the HMRC manuals. If you look at the State Manual 3782, that gives you a good explanation there. So it may therefore be better to distribute this old income, if you like, to the beneficiaries prior to the 10-year charge, and so that they can reclaim the tax which will have built up in the tax pool. And it may also just be better just to simply pay the tax due on the 10-year charge as income which is deemed to be capital for IHT purposes, retains its nature of undistributed income, so that the trustees can continue to make income distributions on which the beneficiaries can reclaim the tax credit. And again, this all needs to be looked at well in advance of the 10-year charge, and this is also sort of highlights the importance, I can't stress this enough, of having good trust records.
Okay, so forward planning seems to be the key with all of this, I think it'd be fair to say. Lindsay, one question that's come in, we've talked about a significant number of tax events for IHT purposes, and we touched upon, you know, some of the non-tax reasons for having trusts and asset protection just before, but in a nutshell, why should I have a relevant property trust in light of all these potential tax charges? What is the key driver, both tax and perhaps non-tax? Lindsay, can you summarise that for us?
Well, because you can give away, it immediately takes 325,000 out of your estate, and if provided you survive 7 years, you'd have removed that from your estate, so you won't be paying inheritance tax on that at 40%. So you're making use of your nil rate bands. Okay. So every 7 years you get another nil rate band, if you like.
Okay, so again, it all needs careful planning, I think, is the key message. It's not a panacea as such. But okay, so lots of potential tax charges for IHT purposes. There's plenty to think about from mitigating the tax charges, particularly it seems when we're coming up to that 10-year anniversary. But as far as compliance and reporting goes, let's just have a think about what can go wrong and what hopefully we can avoid going wrong in the future.
Yeah, so we commonly see a lot of issues with inheritance tax reporting, which is quite often related to missing the 10-year anniversary charge.
Yeah, there's two reasons for this. There's we see a lot of charges that are missed, and that's generally where a family member has been managing the trust and is not up to speed with the changes in legislation. They may not realise that their trust is fallen into the relevant property regime post 2006. And the other side of it is where just a record of the key dates hasn't been kept. So it's just overlooked, just generally overlooked.
And sometimes we've seen that the wrong rate of tax has actually been applied with regard to 10-year anniversaries. Yes,
I'm actually working on a case at the moment where the rate of tax used was 20% to fund the exit charge, and they actually sold investments and incurred a capital gains tax liability. So we're sort of in the process of correcting matters with HMRC, and the overpaid IHT will come back, but in the meantime they've paid capital gains tax, which wasn't payable, necessarily payable, was not necessary.
Indeed. Yeah, and with undistributed income, you know, which has been included in the value of the trust fund when calculating the inheritance tax charge on a 10-year anniversary as well.
Yeah, this is, again, we go back to the importance of keeping track of the undistributed income. Undistributed income is not relevant property, only if it's over 5 years old, whereas accumulated income is relevant property.
Yeah. No, and the other thing we've come across is where reliefs haven't been claimed, or where there's jointly held property and they haven't applied a discount.
Yeah, this one is typically we see this where half the family home is held in a discretionary will trust and the other half is held by the surviving spouse, and then on the 10-year anniversary a discount for joint ownership would apply, but often we see this discount being overlooked with the result that additional inheritance tax is being paid.
Yeah, and then of course there's the 18 to 25 trusts.
Yes, this one. See lots of errors on this one. These types of trusts are not subject to 10-year charges. They're subject to an exit charge when the property vests in the beneficiary. That's on age 25, or if there's been a prior capital appointment. The maximum relevant property period for these types of trusts is 7 years, and that's 18 to 25. That's 25 years less 18 years. So the maximum period that it can be relevant property for is 7 years, and that gives you a rate of 4.2%. And the most common error we see is that these types of trusts have been subject to 10-year charges from 2008. Again, you should keep the trust under review, as it may be prudent to wind up these types of trust early, because every complete quarter prior to the vesting date has a potential tax saving of 0.1.5% or 6% per year.
Okay, thank you for that. So again, it all comes back to really where we started, didn't it? The importance of proper record keeping. If we don't have that, we've got no chance of making sure we comply with all our IHT reporting. Which we've had one question in here. Again, they're all coming in as anonymous today. Don't be shy. Talking about penalties for missing the 10-year anniversary charge. Is that something we see HMRC enforce with an iron fist?
Yeah, actually, I had a really good case. I had a trust we dealt with. There were 2 trusts we dealt with actually in the last couple of years, where they'd missed 3 10-year charges, and we managed to get the penalties mitigated. What happened was the family, their mother had been administering the trust. This is one of the families, been administering the trust. And the daughters came across the papers on her death, were going through it, and then they realised they had a trust, came to us and asked us what it was, what to do with it, etc. And then we managed to write back to the revenue and say that that it was being administered by an elderly lady, and they decided to waive the penalties. There was inheritance tax to pay, and there was interest on the late payment of the tax, but the penalties were all waived. So yes, HMRC do usually charge penalties,
but it's not beyond the realms of reality to get those penalties waived.
Yes, if under certain circumstances, yes, yeah.
What sort of circumstances might be applicable there, Lindsay?
Well, that particular lady was infirm and had been sort of stumbling along for some years, and we went along that basis. But it was quite interesting because the daughters were actually trustees of the trust, but they'd signed up to it at a very young age, and sort of just hadn't realised that they were still trustees, and that the mother had been dealing with everything. They'd been no distributions had been made. It just sort of like stumbled along, and yeah, it was an interesting one to deal with, and got a good result for them.
Okay, good stuff. Okay, I think, Kate, you're now going to talk to us about parental settlements.
Well, yeah, parental settlements, these are where payments are made on behalf of children that are under the age of 18, but they're actually taxable on the settlor. I think, Lindsay,
yeah, we do.
We've seen some stuff like this.
We do. We've often seen R185s erroneously being issued to the children, and then tax reclaims have been made by the family, and it's common where a family member is dealing with the tax compliance, and they've probably misunderstood the legislation, and HMRC have been known to pick up on this, and it can be very costly to correct matters, as you have to unravel the beneficiary's tax position in addition to the settlor's tax position.
Okay, understood. Again, proper record keeping though. Let's make sure we have the information so we can comply with our obligations. I mean, there is a de minimis here, isn't there? Is it £100?
That's right.
Yeah. So, but
yeah,
generally,
but usually, I mean, people use a lot more than that.
Yeah, but generally, parental settlements, if you've got minor children, they don't really work, I think is the gist of it these days, isn't it? What about Settlor interested trusts? We do see quite a few of these still around.
Yes, it's this one. It's prior to 5th April 2008, the income and gains were reported directly on the settlor's tax return. And, you know, we're 12, 13 years on, and we're still seeing cases where the capital gains are being reported directly by the settlor, in which case, you know, the trustee's annual capital gains tax exemption is not being utilised. And over the last 12 years, the additional tax paid by the settlor, and I did a really quick calculation, so don't hold me to this. I worked out that it could be about £12,000 they've overpaid tax on that. But on the other hand, you could have the situation where the settlor has been claiming losses in the trust personally, which is not allowed. And again, that can be very costly to regularise matters with HMRC. And a really funny one, another common area is that we see that despite the trust being discretionary, where it's a settlor interested trust, they've been taxed as if they're life interest. And again, you know, that's not right, and correcting the matters there again can be quite costly.
Okay, not good, as you say. Okay, so that's the headlines on settlor interested trusts. Taking it one step further, we do need to be very mindful where there's personal use of trust funds by settlors as well, don't we, Lindsay?
We do, and I would say that I think every trust practitioner will have come across this in practice. Many settlors do not realise that they're taxable on the lower of the capital sum paid to them by the trustees or the available income. That, and by available income, I mean the undistributed income in the trust, and that actually can be a quite substantial balance. So if you go to the next slide, Tony, you can see what the definition of a capital sum is, and that might surprise a few people in that it's not just lending money to the settlor which is treated as a capital sum. It's also the repayment. You know, the settlor may have lent money to the trust, and on repayment of that loan, that is treated as a capital sum as well. And you may think, well, how do HMRC pick up on all of this? Well, they have started to pick up on this because you've got an awful lot more trust going into that relevant property regime, and therefore there's a reporting requirement. And if you look at the IHT 100 manual and the form D33, you can see the level of disclosure required if you've got a loan outstanding at the 10-year charge. And then also you need to look at the self-assessment tax return, question 15, and this is very, very often gets overlooked. The level of information there, you need to disclose whether a loan has been made or you have any income which should be taxed on the settlor in these boxes. And again, this is where having trust records are key, so that you can monitor that undistributed income balance, and then you can assess the potential tax charge on the settlor.
Yeah, I'd like to interject here as well. I mean, the trustees also need to be quite careful that you know, funds being used for the settlor could also result in a breach of trust if it's not in the best interests of the beneficiaries, of course.
Mm-hmm. That's a good point. Very good point.
Okay, couple of questions. Maybe we'll pick up on those on the end, because I think we want to move on to one other type of trust we mentioned before, which are employee benefit trusts. And we used to see these quite often in the past. I say that my sort of corporate hat here, that they used to provide quite a generous tax break for companies who would make contributions to EBTs and get an immediate tax deduction for that. So even if the funds went nowhere at that point, and suffice to say, HMRC didn't particularly like that. There was a number of cases where HMRC littered against these. I think it was Dextra case, wasn't it? Was it Geraint? If that rings any bells with you, Dextra, I think. And the legislation has now been amended anyhow to put beyond doubt that it's only broadly when the funds come out of the EBT that the company gets a tax deduction. So that's all sort of by the by, as it were. Because Lindsay, do you want to talk a bit about the direct tax treatment here?
It's a very specialist area, and you know, I'll often be asked to advise on the tax consequences of winding up an EBT. But EBT, that's just a generic title, and you can in fact be looking at an employee share scheme, retirement benefit scheme, and some of the abbreviations you might know. So it might be a FERB, an EFERB, ESOP, SIP, ESOTs. That's just to name a few. There are loads. And it's really key to identify what you're dealing with, as the tax treatment for each one is very different. The most common types of EBT we see have been set up to provide benefits and bonuses to employees or beneficiaries, and to hold shares to satisfy share options that have been exercised by the employees. And distributions from these trusts are taxed as emoluments and are subject to PAYE and NIC, which is reported via the company payroll. And I have come across cases where I've seen these income distributions being R185s being issued for the beneficiary, and it hasn't gone through the company payroll. It's gone through the trust tax return, and they've issued R185s, which is incorrect. You get this double taxation, because obviously the trustees have paid tax at the rate applicable to trusts, and then also the beneficiary or the employees, they've suffered PAYE and NIC on what they've had. And to counteract this, you have to make a claim via the self-assessment tax return in the year the distributions are made. You used to have to make this claim off the tax return, outside the tax return, but now you have to make it via the return, and that often gets overlooked, so with the result that the trustees are losing out on tax repayments. For IHT, generally the trusts are outside the scope of IHT, so they're not subject to tenure charges, exit charges, etc. However, there are situations where inheritance tax arises, for example, on the granting of options at undervalue to associated persons, and it's a very, very specialist area, and the tax compliance requires a high level of review to mitigate any costly tax errors. It's not you can't really process tax returns for EBTs.
Yeah, they do seem to have been somewhat tainted by reputation, some of these EBTs. They're certainly, in the past, they were seen as vehicles for tax avoidance, which, as we said, HMRC are very much clamped down on. But they're still around, and they still do have very much a legitimate purpose, don't they? We do see them, as we said, as a warehouse for share options and shares in companies, etc., etc. So certainly something worth bearing in mind, but albeit, as I think you've set out very clearly there, Lindsay, extremely complex.
They are, yeah.
So do seek advice as necessary. Let's move on then and talk about accumulation periods. Do you want to just, I think, Kate, you were going to cover this. What do we mean by accumulation period, first of all, and then we can talk about the consequences?
Well, the accumulation period basically refers to the income, a period when the trustees are able to accumulate the income, which Lindsay mentioned earlier, is to effectively reclassify the income as capital. And that has a finite amount of time, depends on the trustee. It's not always mentioned in there, but I know this area causes a lot of problems when the period comes to an end.
It is. It's sort of income received after the end of the accumulation period, and that has to be paid out to beneficiaries of the trust. It can't be accumulated, so you can't add that to capital and reinvest it. What I have seen in the past, and it's quite common, is that people think that when that accumulation period ends and the income has to be paid out, the trust income is no longer taxed at the rate applicable to trust. It's treated as if it's a life interest trust. Well, that's not always the case. I mean, if you have a discretionary trust, then the income continues to be taxed at the rate applicable to trusts, and it's where the trustees have got the discretion to pay the income in any share as they see fit, but it continues to be taxed at that trust rate. 18 to 25 trusts, the income from age 18 will be taxed on a life interest basis, and the undistributed income prior to the beneficiary attaining 18, that becomes capital, that gets accumulated. And a common error we see in practice is where the income of an 18 to 25 trust continues to be taxed on a discretionary basis right the way through until the beneficiary becomes absolutely entitled at age 25.
Okay. All right then. I think we're nearly done, team.
Yeah.
Finally, Geraint, bring us home. Just want to say a few words about the interpretation of trust deeds.
Absolutely. I mean, one of the phrases that Lindsay and Kate have repeatedly been using for the last 45 minutes is "it depends on the trust deed." And unsurprisingly, it certainly does. You really do need to understand the trust deed, to read through it very carefully and understand precisely what kind of trust it is, what the powers of the trustees are, and what can and can't be done. So as we say here, do you really, really know what you've got here? Is it a qualifying life interest? When does the trust end? Have you considered Section 31 of the Trustee Act? That's the making payments for maintenance, education and benefit of people. Has it been amended? If not, you could have problems with young beneficiaries taking rights to income at the age of 18. This could be very significant if you're got one of these pre-2006 trusts that we mentioned earlier. I mean, ideally, you want your trust to be flexible. So can you break the trust at any point? What powers do you have to amend the trust deed? Are there any powers of appointment? All these things are relevant. We've got here, has Section 32 of the Trustee Act been extended? That's the power of advancement section. Are the beneficiaries between them absolutely entitled? And do you need to consider Crow versus Appleby? That was the land one where the final entitlement didn't take place for everybody until the youngest person had attained the age of 25. So it required the final person to fulfill the requirements. You didn't get it on a kind of sequential basis as each individual person did. So it is very, very important that interpretation of trust deeds has been done correctly, and this is something that BKL can help with. We can look through your trust deeds and tell you exactly what the obligations are, what kind of trust it is, what's the reporting requirements, and even what has and hasn't been done on what should and shouldn't have been done. So don't underestimate the importance of these. And as anyone who's read through a trust deed will know, they can be impenetrably complicated and mystifying. But we're lucky to have people here who do understand them. So please feel free to get in contact with us if we can help in that way.
Okay, lovely. Thank you very much. Good news, team. We've got a few minutes left, so perhaps we'll just take a couple of questions, if we may. Here's one, again from Anonymous, I'm afraid. Form 185s we talked about before, issued on income distributions. Lindsay, I think you covered this briefly before. Are there any forms required to be issued by the trustees on capital distributions?
No, but only if you're making a capital appointment, the trustees, they may need a deed. It depends what it says in the trust deed, whether you need to make a capital appointment by a deed or whether you can do it by trustees resolution. But no, you don't need to issue like an R185 certificate for capital. No.
Okay, thank you. We also touched upon parental settlements before. If a parental trust is created and no distributions are made, then no tax charge arises, question mark. True or false? Kate, Lindsay, anyone want to pick that up?
In what way? In what way? Do they mean income or?
Yes, I think so.
So no, there won't be any income tax charge. There's no income in it.
No distributions made. Okay, well, not quite sure who sent that in, but if you want to clarify exactly what your question was, we'd be happy to pick that up. Not sure if we can answer this, but let's try. My solicitor deals with my family trust and doesn't keep accurate accounts, even though I've asked for these. Tut tut. Are they very different to normal limited company accounts?
Yes. trust accounts, you really need to separate the income and capital. You need to keep track of that separately.
Right.
It depends on the terms of the trust as well. If they're absolutely entitled to the income, I'd expect to see a beneficiaries account, not an undistributed income account. I've often come across accounts where they've mixed up the capital and income. They've just called it like a profit and loss account, and you've got capital and income all intermingled, and that's totally wrong, because you've got an income beneficiary which may be completely different from a capital beneficiary. So you definitely need to keep things separate. But I would say look at the STEP guidelines. The STEP guidelines on trust accounts are brilliant. We refer to that all the time.
Where can we find that, Lindsay? That's your
on the STEP website.
Yeah. Okay. All right. Thank you for that. And finally, for the star prize, here we go. Father died and left money in trust for his minor children and other relatives. Payments have been made not out of income to cover school fees, etc. Presumably, we need to prepare an exit charge return each and every time they make such a payment.
Well, I know what they're getting at here, because you tend to see payments made so that because of the tax pool, they're restricting payments of income so that you don't get this what's called a tax pool charge. So if you're making capital distributions, what I tend to do is I treat them as a loan and then lump them together and then do one, and capitalize it at the 10-year charge date, because the compliance of doing an IHT return every year can be quite costly. Say for example, you're just making capital payments of £100 each to beneficiaries, and then you have to do an IHT return every year for that. It's not cost effective. So I tend to sort of like capitalize it, treat it as a loan, and then capitalize it at the 10-year charge date. You have to sort of like weigh up what is the tax consequence of doing that to get the best outcome, because you weigh it up with the costs of doing the IHT compliance every year. And I've actually had one case where HMRC wrote back to the trustee because he was submitting tiny little IHT returns exit charges on like £50, and they wrote back and said, these aren't necessary. So yeah.
All right, I think we will leave it there. All that remains is for me to say thank you very much to Kate, to Lindsay, and to Geraint. Thank you for your pearls of wisdom. There are contact details if you've got any more questions on this, or perhaps even our probate services as well, Geraint, that we'll maybe cover in another webinar. We have only scratched the surface today, though, we'd hasten to add, but I hope that's given you a good flavour of the issues and the sort of problems that can arise. If you do need any help in the future, do feel free to contact us direct. Otherwise, from us all, thank you very much for joining us. Do take care, do keep safe, and we look forward to you joining us again soon. So thank you very much, and goodbye from all of us. Bye-bye now.
Bye.
Goodbye. Bye.
Bye.